time for the 360 round. We're talking Constellation Brands after earnings. For that, let's bring in our panel. Bill Kirk is Managing Director of Roth Capital Partners, and Dan Ahrens is Managing Director and Portfolio Manager at Advisor Shares. Great to have you both here. Dan, let's start with you. It was a mixed report, an earnings beat, a revenue miss. They backed their full year outlook, but something must have been said on that earnings call because shares were flat at the open, and now they're down 3%. What are your thoughts on this mixed report, if you will?
Well, it's good that they held guidance, but we currently have Constellation as an avoid. We have owned it in the past in our VICE ETF that typically owns stocks like alcohol companies. But in the current environment, we only own a couple different alcohol companies in that fund. They're greatly underweighted. We are not fans of Constellation Brands right now. And frankly, in the past, most people saw different rotations in alcohol. And what I mean there is out of big beer and perhaps into higher end distilled spirits. But right now, we're really not seeing much growth prospects in alcohol at all. Comparatively, there's a lot more cannabis sales and hemp-derived beverage sales that are really dinging a lot of alcohol revenue.
Okay. All right. Well, I'll talk to you about some of your picks instead in just a second. But Bill, I want to bring you into the conversation. You have a buy rating and a $305 price target on shares of Constellation. I'm curious what gets it there and what in this report helps or potentially hurts, because I'm seeing a headline saying expect lower volumes and margins in the second half of the year. Does that shake your confidence at all?
Yeah, it does not. This reaction today is the wrong reaction. For all the issues that the larger beer industry may have, Constellation does not share those issues. Constellation's beer business is growing 7%. It is now entering the seasonally largest period of the year. Every single week between Memorial Day and Labor Day, every single week is bigger than the Super Bowl. And all the shelf space gains that they received from retailers, they start to matter in the summer. When the consumption spikes, that's when being in stock on shelf at retail every large weekend really matters. So we actually think their performance from here can accelerate. If you look against the broader consumer staples world, their growth rate is 4.5 percentage points better than the CPG sector. And it should trade at a larger premium than it does to the sector. It trades at a very modest premium to the sector. But with that kind of outperformance, it is misunderstood relative to peers, relative to beer, and entering the summer.
Okay. So, Dan, you mentioned it's an avoid for you. It doesn't sound like you have a lot of bullishness in the space overall, but what would you like more?
Well, in the alcohol space, our VICE ETF does still own a couple companies, but again, I need to stress those are currently underweighted right now. We're not seeing a lot of growth prospects in alcohol at all. We do hold Molson Coors, ticker symbol TAP. We also hold a small position in Boston Beer, SAM. Another interesting alcohol company that a lot of people don't know about is called MGP Ingredients, MGPI. They sell a lot of bulk alcohol and have some brands as well. In our VICE ETF, we're really weighting much more towards gaming. I mean, online gaming as well as casino gaming and restaurants. Fast casual restaurants are doing well in this environment, but we're shying away from beer.
But Dan, just to follow up on your VICE ETF, I was taking a look at the holdings. The biggest holding is NVIDIA. I don't necessarily. So are you looking at AI as a VICE? And I also saw Ferrari in there. I wish that I could afford to have a Ferrari as a VICE. But, an interesting biggest holding in NVIDIA, not necessarily what one would think of as a VICE.
Well, it's all about gaming. That's all about online gaming, which overlaps into AI, of course. It's about their chip business. And so it's it's not a core holding in VICE that most people think of as alcohol and tobacco and gambling. But there's so much growth in online AI and gaming. That's why we have NVIDIA in that position there.
All right, Bill, I want to bring it back to Constellation because it really just shows that beer continues to be strong, wine continues to be weak. Is that particular to Constellation, or is that just a new trend or a trend that we'll continue to see down the line in general?
That's not unique to Constellation. That is a larger industry phenomenon. Wine is softer than beer. Wine is a particularly hard category to develop brands in. A lot of wine drinkers shop by style, varietals, rather than have a specific brand. There's brand loyalties. Beer. But what's remarkable about Constellation is they're delivering almost 10% earnings growth, despite their wine business being down 10%, despite their beer expenses going up on the depreciation side, and their capital spend going up. And I think that underscores just how strong that core business is, that your total company can still grow earnings 10% despite those issues and despite that exposure from wine.
And Bill, just quickly, is it a real threat? I'm seeing so many, non-alcoholic options now, and it seems like a lot of people are sober curious, if you will. Is that a big threat to a brand like Constellation?
They've even launched their own. There's a non-alc version of Corona that came out earlier this year. Non-alc as a total percentage of beer is about 1%, but it is growing about 30%. So it's only 1 point of the entire industry, but it is growing rather rapidly. The options have become much better, led probably by Athletic Brewing. The taste profiles are a lot better of the products. And they do substitute for some beer occasions, maybe some weekday occasions, maybe some pace of consumption type of occasions. So it is taking away a little bit from beer, but again, it's 1 percentage point growing 30% per year. So the headwind to beer then, I guess, would be just 0.3 percentage points a year. So not the dramatic maybe substitution that some people make it out to be.
All right, we'll have to leave it there. Bill Kirk, Roth Capital Partners, Dan Ahrens, Advisor Shares. Thank you both so much for joining us on Trading 360.